Hello and welcome back to Global Value. In today's video, we're performing a fundamental stock analysis of the Kraft Heinz company, ticker symbol KHC. Warren Buffett's Berkshire Hathaway owns 27% of Kraft Heinz. Together with 3G Capital Management, Berkshire Hathaway financed a deal in 2017 to merge Kraft with Heinz. We're looking at the business today because their stock price is up so far over the past year, which is in stark contrast to the S&P 500. So currently, Kraft Heinz is trading for $38.10 per share. Over the past year, their stock price is up 4%. Over 5 years, however, their stock price has declined by 14% annually. And since the two businesses merged together publicly, their stock price is down exactly 50%. Warren Buffett has publicly stated that although Kraft and Heinz were great businesses, Heinz was especially the great business and that they overpaid for Kraft. Because of this, their returns have been negative over this period. Although Kraft Heinz does currently pay out a 4.2% dividend yield, overall returns to shareholders are not as bad as what their stock price might reflect. Kraft Heinz tends not to have a ton of volatility in their stock price. They're currently right between their 52-week high and their 52-week low, and they are a large business. They have about a $47 billion market cap. For additional background about the company, in July 2015, Kraft merged with Heinz to create the third largest food and beverage manufacturer in North America, behind PepsiCo and Nestle, and the fifth largest player in the world. Beyond its namesake brands, the combined firm's portfolio includes Oscar Mayer, Velveeta, and Philadelphia. Outside North America, the firm's global reach counts a distribution network in Europe and emerging markets that drives around 1/5 of its consolidated sales base, as its products are sold in more than 190 countries and territories. The Kraft Heinz company was founded in 1869 and is headquartered in Pittsburgh, Pennsylvania. So for our fundamental analysis today, we are performing the Select 6 analysis, taking a checklist-style approach of 6 standard financial metrics to come to a holistic and beginning understanding of Kraft Heinz based off of their business fundamentals. So this analysis will continue to evolve and improve over time. It's still a work in progress, and it's an opportunity to learn in public. So with that said, let's get right into today's analysis. Starting things off with metric number 1, we want their average return on capital over the past 5 years to be above 14%. So there are 2 reasons for this. The first is that over the long run, over the course of decades, a stock is likely to return approximately what its underlying business returns. The second is that the average publicly listed business earns about a 7% return on capital. So by asking for 14% or higher here as our benchmark, we can potentially build in some margin of safety based on the overall quality of the business being about twice as good as average. Kraft Heinz over this time is earning steady but below average returns on capital. Over their last 12 months, they've earned about 6.3% returns on capital. And over the last 5 years, averaged out, they're earning about 6.5% returns on capital. So the return that they're getting on incremental spend in their business is slightly below average. And this is an X to start off on metric number 1. Metric number 2, here we're taking a high-level overview of the cash coming into their business. We want to see revenue, earnings, and free cash flow growth over the last 5 years, and we'll also be including their last 12 months worth of numbers here. So this metric is all or nothing in nature. Either all 3 of these are going to be up for a check, or if even one of them is down, this entire metric will be an X. So over the last 5 years, their revenues are pretty much stagnant. They're down just a tiny bit, but other than that, almost exactly flat. Their earnings appear to be down by more than 90%, but if we dig in deeper, that's because they had a huge income tax credit in 2017, and then they had a massive asset write-down in 2018. Even if we were to exclude those two and get a sense of their normalized earnings, their earnings would still be down from where they were back in 2017 and 2018. The bright spot for the company, though, is that their cash flows have gone from being negative in 2017 to now they're pretty positive, and Kraft Heinz has produced positive free cash flow since 2018. So their cash flows are up over this time if that's any consolidation. That's probably the most important out of these 3 metrics because cash flow is really the lifeblood of any business, and a business's abilities to produce free cash flows now and until Judgment Day, discounted back by some reasonable interest rate, is ultimately what that business is going to be worth. A business can use their free cash flows to reinvest back into the company, make acquisitions, pay down debt, buy back shares, or pay dividends. So it is good to see that Kraft Heinz, through some of the zero-based budgeting that their main operator 3G Capital is really known for, has been able to produce positive free cash flows over the last 4.5 years or so. Even though this is our second X in a row on metric number 2, not everything looks so bad for Kraft Heinz so far. Next up for metric number 3, here we're taking the perspective of an individual shareholder in the business by looking at Kraft Heinz on a per share basis. So we're looking for earnings per share growth over the last 5 years. Again, Kraft Heinz had pretty abnormal years in 2017 and 2018 because of income tax benefit and then this massive write-off in 2018. However, even on a more normalized earnings basis, excluding those 2 extra items in 2017 and 2018, the business has not been able to grow their earnings per share Their earnings are still down over this time, and they've kept their shares outstanding pretty much flat. So this means that this is going to be another X here on metric number 3. So far through our first 3 metrics, we are 0 for 3 to start things off. Metric number 4 is going to be very similar. Here we're looking for free cash flow per share growth over the last 5 years. Their free cash flow per share growth is really going to be dependent on their free cash flows. And over this time, Kraft Heinz has swung their free cash flows from being negative to now being positive. So we're seeing free cash flow per share growth, and this is going to be our first coming in on metric number 4. Next up, for metric number 5, here we're evaluating how the business is utilizing debt. So we don't want to be investing in overly levered businesses because during economic downturns, it's overly levered businesses that are at the greatest risk of poor outcomes. Kraft Heinz had quite the debt load post its merger. Since 2018, they've been pretty much aggressively paying down this debt. They ended last year with $19.2 billion worth of net debt, and currently their net debt is almost exactly the same. Over this time, Kraft Heinz has produced just under $13 billion worth of free cash flow in these 5 years combined. So again, they did have negative free cash flows in 2017, and they've been positive since. They have also managed to grow their free cash flows, and so while this is going to be an X on metric number 5, as relative to their abilities to produce free cash flows, it does look like the business is using quite a bit of leverage. There are some key caveats to this. One is that Berkshire Hathaway, of course, owns 27% of the business. Warren Buffett is not the type of business owner who's going to let companies that report under Berkshire Hathaway's consolidated financials be in a financially precarious position. So while Warren Buffett did admit to paying too much for the business and they did settle on a lot of this debt, it's likely that their higher debt loads are not as much of a concern, especially compared to other businesses. And they've significantly improved their cash flows over this time. So the average historical basis here might not be as pertinent as it would be for some other businesses that had more steady cash flows. So ultimately, if you were potentially concerned about their debt position, you would just want to learn more about the business and do the work to understand how their debt loads are structured in more detail. Even with these caveats, this is an X on metric number 5, and so far through our first 5 metrics, we have 1 check and 4 X's. The big metric of them all, metric number 6, we want their average free cash flow to their total enterprise value to give us a yield that's above 5%. If this is the case, this will potentially give us a slight risk premium to the rate of the 10-year Treasury yield and give us another reason to be potentially interested in Kraft Heinz. So we're using their total enterprise value here to get a sense of the business as if the company were a private business by taking into account both their market cap and their net debt position. So currently Kraft Heinz has a $66 billion total enterprise value. That's almost exactly in between where their high and their low have been over the past year or so. And we learned that over the past 5 years, Kraft Heinz has produced just under $13 billion worth of free cash flow. So in an average year over this time, Kraft Heinz is producing about $2.55 billion worth of free cash flow. So when we divide their $2.5 billion worth of average free cash flows by their $66 billion total enterprise value, that gives us an average free cash flow to enterprise value yield of 3.8%. That's just slightly below the rate of the 10-year Treasury yield right now, and that is below that 5% mark we're ideally looking for. So on an average basis, this is going to be an X on metric number 6. Worth pointing out, though, is that over their last 12 months, Kraft Heinz has produced about $3.55 billion worth of free cash flow. So to get a current free cash flow to enterprise value yield for their business, when we divide their $3.5 billion of their last 12 months worth of free cash flow by their $66 billion total enterprise value, that gives us a current free cash flow to enterprise value yield of 5.4%. So that is above that 5% threshold, and that would potentially give a slight risk premium to the rate of the 10-year Treasury yield. So chances are, because on an average and a current basis, that these are on either end of that yield, that the economic reality for the business probably lies somewhere in between the two. And to get a better sense of what their cash flows could potentially be like going into the future, you would just want to learn about the company in more detail. So just because this is an X here on metric number 6 doesn't mean that you're going to toss out this business entirely. This is just one data point out of our 6 metrics, and this analysis is meant to be taken in holistically. Then here we're taking a look at Kraft Heinz dividend profile. So currently Kraft Heinz has a 4.2% dividend yield, which is quite high compared to a lot of other businesses, and especially high compared to the yield of an S&P 500 ETF. However, people make mistakes all the time by blindly chasing dividend yields, so it's important to stop and consider the fundamentals of a business and to determine whether or not a company's abilities to pay out their dividends are well supported by their cash flows or their earnings, depending on the type of business. We want Kraft Heinz to be able to support their dividends with their free cash flows. And so while that wasn't necessarily the case in 2017 or 2018, since 2019, they have supported their dividends with their free cash flows. After moderately increasing their dividend year over year from 2017 to 2018, they slashed this, and since then, they've kept their dividend flat from 2019 onwards. At the same time, they've managed to grow their free cash flows per share, and now they're paying out a much more modest dividend payout ratio of less than 50% of their cash flows. So if they're able to continue this into the future, it would look like Kraft Heinz dividend profile would be in potentially good shape moving forward. Then here we're using a discounted cash flow model to come to a potential fair value for Kraft Heinz. So please be aware that a discounted cash flow model, like any other model in any other discipline, is going to have its outputs be sensitive to its inputs. Here we're starting with an average of their free cash flows and then projecting those free cash flows out into the future based off their historical abilities to grow their free cash flows over the last decade, assuming a growth stage over the next 10 years for the business where their free cash flows decline at a rate of 2% annually, and then assuming a terminal stage for the business over the next 10 years out after that where their free cash flows decline at a rate of 4% annually. Then if you were seeking a 10% rate of return for Kraft Heinz, it looks like a potential fair value for their business would be about $22 per share. Please keep in mind that this model is based off of these historical growth assumptions, which you need to do your own homework on to determine whether or not these are both going to be potentially accurate and applicable to give us a baseline projected estimate of Kraft Heinz going forward over the next 20 years. So using these same historical growth assumptions, it looks like from today's prices, you could reasonably expect about a 2.5% rate of return going forward from Kraft Heinz, which because of their 4.2% dividend yield, means that the company's stock price would actually be declining over this period, as their dividend yield would be included in this discount rate. There are a number of reasons why this type of DCF valuation would potentially be inaccurate or would not give us the best estimate of the business possible. So it's ultimately up to you to learn more about the business, to be able to tweak these inputs and to understand where their cash flows could potentially be at in the future. So this type of analysis is not financial advice. It's not a buy or sell recommendation of any security. And before considering any potential investment decision, please consult with the properly licensed and registered legal and financial professionals. One resource that will definitely help you stay up to speed with what's going on in the market and help you learn more about the business is Seeking Alpha. Checking out Seeking Alpha directly supports the channel as I'm part of their affiliate program. So most of you probably know Seeking Alpha as a source of community-written articles on different stocks. But over the past little while, they've actually become a lot more than that with their new offering, which is Seeking Alpha Premium. Premium has a number of different features where you can track buy, hold, and sell ratings on your favorite stocks. These ratings are from the Seeking Alpha community, Wall Street analysts, and Seeking Alpha's algorithm. You can see earnings call transcripts, investor presentations, SEC filings, and press releases all in one place. You can add your own margin of safety targets and get alerts for when your favorite stocks hit that level. You can get unlimited access to Seeking Alpha articles, and you can tailor your reading experience based on the type of investor you are. You can get 10 years of financial data on any stock to help you with your analysis. You can also import your portfolio into your Seeking Alpha dashboard to make researching easier. And if that didn't convince you, the best thing is that an annual plan is only $99. That's only 27 cents per day through my referral link down in the description below. Normally, premium is $239, but they are currently running a general offer for $119. But if you use my link, it's only $99. So check it out if you're interested. So in summary, Kraft Heinz checks the box on only 1 out of 6 of our metrics. Over the last 5 years, they've seen their free cash flows go from being negative to being positive, and they've kept their shares outstanding pretty much flat. So they've experienced free cash flow per share growth. However, Kraft Heinz was off on all of our other metrics. They're earning just about average returns on capital. Their revenues are pretty much flat. Their earnings, even when we normalize them and exclude some of these extra charges, are still down. It looks like even though Kraft Heinz is primarily owned by Warren Buffett's Berkshire Hathaway, they're using more leverage in their business than we would ideally be comfortable with. Although again, because of their Berkshire roots, this likely isn't as much of a problem as it would be for some other businesses. And then on an average basis, their free cash flows are not giving us the appropriate yield relative to their enterprise value that we would ideally be seeking to get a adequate risk premium compared to the rate of the 10-year treasury. However, it does look like based off of their current free cash flow to enterprise value yield that there would be a potential risk premium there. So if you're interested in the business, you would either want to read write-ups of the company or dig into their filings to learn more. It also looks like they've stabilized their free cash flows over the past several years and that their dividend profile looks to be in pretty good shape and that they're paying out an above average yield of 4.2% annually. Then finally, performing a discounted cash flow analysis of the Kraft Heinz company using those historical growth assumptions, which you need to do your own due diligence on. If you believe those assumptions, then over the next 20 years, Kraft Heinz share price would actually be declining from where it's at today, and the only return that would be going to shareholders would be coming from their dividend payouts. Again, there are a number of reasons why that wouldn't be potentially accurate going forward for the business. It's worth reiterating that this type of analysis is not financial advice. It's not a buy or sell recommendation of any security, and before considering any potential investment decision, please consult with the properly licensed and registered legal and financial professionals and do your own due diligence. Instead, this analysis serves as a beginning and holistic understanding of the Kraft Heinz company to help you determine whether or not it's worth your time to dig in and learn more about the company going forward. As a value investor, you're ultimately trying to learn about a business as if you're going to own 100% of it, and you can understand the essence of that company and understand what's important and what's not important for that business moving forward. Through this deeper research, you'll ultimately learn more about both the qualitative and the quantitative aspects of the Kraft Heinz company, and you'll likely be able to come to your own reasonable approximation of a fair value for the business. So with that said, that's it for today's fundamental stock analysis of the Kraft Heinz company, ticker symbol KHC. As mentioned, Berkshire Hathaway owns 27% of the business, and they're currently paying out a pretty high dividend yield, especially compared to the yield of that of an S&P 500 ETF. So it's always interesting to look at the businesses that are in Warren Buffett's portfolio. And if you enjoyed today's analysis, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next time. Thanks for learning about Kraft Heinz with me, and have a great day.